Today we are here with Dan O'Neill from Grainfield, and super excited because what we've had going on behind the scenes here at REVISOR, we've got relationships with these systems such as Case and iCapital, where the advisors we work with, we basically get all the plumbing in place so that they can seamlessly execute private equity hedge fund strategies into their clients' portfolios. We have had some requests for basically pulling some of the cost out of that infrastructure. So just to be really transparent, that's been the main concern for a lot of the advisors that we work with, is they like the operational efficiency of systems like Case and iCapital. They plan to use those systems as well. It's not that they have no use for them whatsoever, but there's been a lot of concern about the total cost structure that comes into place with these nice operational platforms. And so we set out on a mission to start our own platform on the private equity hedge fund side of the equation that would essentially be an additional option for our advisors above and beyond Case and iCapital. And we're super excited because Grainfield is the first offering that we're adding to that REVISOR private platform. And we've got Dan O'Neill, the founder, here with us today. They've got some awesome information to share with us. And here we go. Dan, thank you for coming on. Share some awesome stuff with us, brother.
Good morning, Landon, and good morning, everyone, and welcome to the webinar today. My name is Dan O'Neill. I'm a partner with Grainfield Capital Management. Really excited to be with you today, and thanks for making the time to join. Special thanks to Landon and Nick and Eva, Ethan, the entire REVISOR team for the opportunity to have this conversation today with you guys about Midwest farmland and why we think it's such a unique and compelling asset class.
Well, Dan, just so you know, I grew up in the Midwest. I grew up in Southern Illinois and drove around. I was a wild, rambunctious teenager, always looking for a good cornfield to go sit out and drink some beer and do the kind of things that we did. And there is a plethora of soybean fields and cornfields and you name it in the Midwest. And so this is nostalgic to me, brother. This is great.
Well, I'm glad to be able to take you back a little bit, Landon. We're going to have a great chat today, and I'm really excited to be here. Before we get rolling, of course, the required disclaimer. It's going to sound familiar to everyone here. I think it can be boiled down to a single sentence. It's going to sound really familiar. Past performance is not a guarantee of future results, and every investment entails risk.
Yes. Thank you.
All right. A quick agenda, maybe to help guide the conversation today. I'll start off with a brief introduction to our fund and our strategy. We'll spend most of our time then on what makes farmland such an interesting investment. Of course, we'd like to explain a little bit about why we think we have a real edge in the space and a pretty interesting opportunity here at Grainfield. And then we'll leave some time at the end for a little bit of Q&A. I think we'll probably do some Q&A as we proceed throughout the presentation too.
Awesome.
All right. Well, let's start off here with who we are. We are Grainfield Capital Management. We raise investor capital, and we use that capital to build and actively manage portfolios of Midwest farmland. Our focus is really on quality, productive corn and soybean row crop land in the heart of the Corn Belt, with an emphasis on Illinois and Iowa. We do have the ability to kind of go into some select neighboring states if we find, farms that meet our criteria and that we think we can buy for reasonable prices. But our focus is really Illinois and Iowa. And the reason for this is, in our experience, the best returns come from buying farmland in areas that have really high productivity soil, ample water supplies. Of course, we prefer natural rainfall rather than irrigation, and lots and lots of great operators. You got to have great farmers, highly efficient, larger scale, forward-thinking people who make good use of technology, and of course are good stewards of the land. So When you put all this together, of course, it leads you right to America's Corn Belt. And importantly, our strategy is not just a simple buy and hold strategy, it's a value add strategy. So we're looking for really good farms that ideally still allow us to make operational improvements or thoughtful strategic investments to increase their productivity, their efficiency, and their sustainability. And that is, we believe, how you really drive longer run asset appreciation. Probably not unlike a lot of funds out there, right? You got to have a value add strategy. You can't just be a simple buy and hold investor.
Absolutely.
Okay, so now that you know a little bit about what we do, and we'll certainly go into more detail about what we do later in the webinar, but the obvious first question is, why invest in farmland? There are lots of investments out there. What do we like so much about farmland, and what makes it so unique? Well, the first thing we like about farmland is its track record of excellent risk-adjusted returns. And I think we all know that as investors, it's really tempting just to look at absolute returns, but we really have to look at risk-adjusted returns. What kind of risk is being taken to achieve a return? You know, what kind of volatility as an investor am I going to be asked to endure in order to achieve this return? So I think this table is really, really important. We kind of started off here with maybe the most important slide in the deck. On the left column there, we have a whole bunch of different asset classes. The first three are farmland indexes or benchmarks. The U.S. Ag 32 state, that's a University of Illinois index comprised of the top 32 states by the value of their agricultural production. NCRE Farmland Index, that's the National Council of Real Estate Investment Fiduciaries. That is profit-seeking, professionally managed institutional money invested in farmland. And then you've got the University of Illinois Farmland Index. That's just Illinois in focus, Illinois farmland. We've got three stock market indices: the Dow Jones, the NASDAQ, and the NYSE. We've got AAA corporate bonds, 10-year constant maturity treasury, composite real estate investment trusts, and then gold at the bottom. If you move over a column, you can see the average annual return over the last 30 to 35 years. And what I think really stands out here is farmland returns are pretty competitive with public market equities. I don't think a lot of people know that, but it's very attractive, competitive returns. If you move one column then further to the right, standard deviation, that of course is a measure of volatility, measure of variability of returns. How risky is this asset class? And I think you can clearly see here that farmland is very, very relatively low risk. Far fewer and shallower drawdowns than just about anything here except maybe fixed income. And we think that's pretty remarkable. Minimum annual return, the next column to the right, which is what we think is really astounding about this table. Farmland historically has just had far fewer shallower drawdowns. I mean, it just really pops out at you, doesn't it? And guys, these equity market drawdowns are real. I think there are probably a number of us on this webinar who are old enough to remember things like Black Monday, dot-com meltdown, 9/11, great financial crisis of 08, 09, the COVID plunge. These things seem to happen with more regularity than any statistical model would suggest. And when they do, they can be pretty gut-wrenching and cause a lot of anxiety and panic and sleepless nights. And happily, we just don't see this with farmland. Even though it generates these competitive returns, it's also been relatively a very stable, resilient, steady asset class. So really, really important slide.
It is.
They're not making any more farmland.
They are not, Ethan. No, they're not making any more farmland. That is for sure.
That's one of the most interesting things for me as we talked and I learned more about Grainfield and investing in farmland was where the return comes from. My initial perspective was that, okay, the return is going to be coming from yield. But you mentioned something already that I thought was really important. You're looking for opportunities to make improvements to the land that you purchase. And the other side of this is there's scarcity in farmland. There's only so much of it. We keep developing more and more of the properties around us. And when you look at those maximum returns, look at that 20%, 33% plus, 28%. That's not coming from pure yield. Am I right in saying that?
Yeah, that's exactly right, Ethan. So two components of returns with farmland. One is the annual return that you get from either renting your land to a local operator or farming it yourself. And we do some of both, by the way. We rent some of our land and we farm some of our land, full-scale farming operations. That's one component of total return. The larger component is appreciation in the value of the land over time. And that's the bigger component. There's an old saying in farmland that you make money off the balance sheet, not the income statement.
Yes, absolutely. I was with a group earlier this week, and they were talking about how they had a big cohort of farmers in their community, and they referred to them as the wealthy poor, I think is what they called them. They didn't have a lot of cash, but their balance sheet would show that they have this massive net worth coming from the land. And that was something that surprised me. Again, like I said earlier, I was expecting a much higher component of the return to come from yield, but it makes sense when you look at this. We're not making any more farmland. There's scarcity value to these properties, and especially when you can make improvements to them.
Yeah, there's a lot of wealth out in the countryside, Ethan. I think the overall U.S. farm agriculture economy is something like $4.3 trillion, and I believe $3.8 trillion of that is farmland itself. So, and it's got very, very little debt on it. I think debt on the farmland market is only about 12%. So it's most of it is owned outright, free and clear of any debt, no leverage at all.
Absolutely. Definitely. That's a very interesting. I think a lot of people will find that very interesting.
For sure, for sure. Well, here's another way to kind of think about risk and reward. Sort of says the same thing as the prior slide, but in a little bit of a different way. Most traditional investments require a compromise between risk and return. The more upside potentially entails more risk, and playing it safe usually limits your expected return. So most investments will generally fall into a line from the lower left corner of this chart to the upper right. The more return you want, the more risk you're going to have to live with. But you can see that farmland is different. For more than 3 decades, it's lived in the upper left quadrant of this graph, which means, again, it's produced equity-like returns, but with the steadiness and the low vol and the low risk that you'd expect from fixed income. And again, pretty remarkable. So it's just kind of a different way of looking at the same concept.
Love it.
Well, farmland also offers excellent diversification qualities. And the reason for this is that historically, it's been non-correlated. Actually, it's been negatively correlated, to be more precise, negatively correlated with just about every traditional asset class. It just doesn't move like these other assets. And when you include in a portfolio a non-correlated asset that has attractive risk-adjusted returns, you can actually improve the performance of the overall portfolio. And, this isn't some just academic exercise or theory like we've all heard of modern portfolio theory. The data actually supports this. If you include a modest allocation to farmland in a diversified portfolio, it can actually help improve returns while at the same time reducing risk.
That's the financial advisor dream, Dan. That
non-correlated asset, Ethan.
And you know what's funny? This was a conversation we had behind the scenes. Is like what most financial advisors do, not all, but a large percentage, is they complicate things. They make it too complicated. So you go in and start looking at all of these potential options. Everybody's looking for the same thing. Reduce the volatility of the whole bucket, but don't reduce the return. So we're all accustomed. We all know we can throw cash and government bonds into the mix and reduce the volatility. But the average investor is going, okay, thanks. But that part of my asset allocation, I don't love the average annual return of that piece of the pie. And so this is just such a beautiful way to pull in those that non-correlated feel, reduce the volatility of the whole bucket, do it in a simple way. And last but not least, I really feel like the only negative is that we have liquidity. It's not as liquid as a publicly traded security, but that's not a huge concession to make for the type of benefit that this provides to the portfolio. So we think this looks absolutely beautiful, brother. So
totally agree, Landon. Well said. Well said.
And how hard is it going back? If you wouldn't mind going back to that slide, Dan, how hard is it to actually find non-correlated assets? Because bonds are the perfect example. If you have a diversified bond portfolio, let's just look at 2022 as the example. Unless you truly go short-term government bonds, you can have a lot of volatility in these assets that supposedly have very low correlations to equities. But a lot of them in bear markets, when it's actually the rubber meets the road in a downturn, the assets converge to this volatility of 1. So they have a non-correlation during normal times, but at the worst time, when you really need it, they converge and they have a correlation of 1. And that's a different profile than what we're talking about here with farmland. And those type of assets are incredibly hard to find.
Yeah, I think that's totally true, Ethan. I mentioned earlier in a previous slide that these periods of crisis in the public markets seem to happen more often than anyone thinks they will or should. And yeah, the last several crises that we've seen, one of the takeaways is that all of these supposedly non-correlated assets tend to converge and they all move together in lockstep. So really, really important. Farmland kind of zigs when other assets zag. And that's a really, really important investment attribute here. One of its strengths.
Exactly. I mean, 2022 is just such a good example, and it's so recent that most people can remember the feelings. And I think it was so shocking to see bond values go down 15, 16, 17, 18%. And that's not normal. Obviously, we were dealing with an inflation issue, and I think one of the comments that you're going to have here in a few minutes is commenting on inflation and using farmland as an inflation hedge. But during a period like that where we had high inflation, high correlation of assets like bonds that are all of a sudden correlated to equities, what happened to farmland, and what was it like a year like 2022 like for that type of asset class?
Yeah, pretty flat, Ethan. When those public equities and even fixed income, as you said, were kind of taking it on the chin and experiencing a lot of volatility, farmland was its typical characteristic thing. Stable, steady, resilient, doesn't do a lot, doesn't react to short-term, short-run circumstances, tends to be very stable and steady, and kind of looks out further in time. So that was a great example of how having an allocation to farmland in your portfolio could help provide some ballast to the portfolio.
Yeah, absolutely.
And you got a peek at this next slide, Ethan.
I did. I cheated a little bit.
So let's hit it. So here's one of the jokes when you're doing a presentation is, every slide in the deck is the most important slide in the deck. But this one may be the most important slide aside from that first one. Farmland over time has been really positively correlated with inflation, as you mentioned, Ethan. And that's whether you're using CPI, PPI, or just about any other gauge of inflation. And not only have farmland investments kept up with inflation, they've actually provided a positive spread over inflation, as you can see in this chart, meaning farmland has appreciated at a rate that's exceeded the rate of inflation. So this is another investment attribute we really like. It's a proven hedge against inflation. And the way we like to think about it is farmland is something of a store of value, that preserves the purchasing power of your money while prices of just about everything rise over time. So really, really important from a wealth preservation standpoint.
Yes. Yeah, absolutely. And comparing that with, for example, so the last 18 months or so, there's been this big bid into gold and precious metals, right? Gold and precious metals being bid up, the concerns over government spending, inflation, all of those type of concerns. Gold is it, and gold has been a great hedge for that. Look at the returns for gold for the last couple of years. They've been phenomenal. But the differentiating factor with gold versus farmland, gold does not pay any income, right?
Correct.
Platinum, silver, no income coming from those assets. Farmland very different from that perspective in a positive way. It's an interesting asset that produces good income and also has capital appreciation, inflation protection, all built into one asset class, which I find it's one of the most compelling parts of the story.
Yeah, I agree, Ethan. That's a great point. And man, there's been some volatility in gold and silver markets lately, and that can be tough to stomach. And it's one thing if you're buying gold in the form of like the GLD ETF or something like that, but my background is in commodity futures, and I would not want to be trading gold or silver futures right now. With all that leverage, you can really do some damage to yourself.
Yeah, definitely.
All right, let's keep moving here. So finally, let's talk about some macro trends that we think are going to benefit farmland in the years to come. First of all, world population continues to increase, and obviously this means, quite simply, growing food demand. And second, maybe more importantly, the global middle class continues to expand. And we know that when disposable income rises, there are two things that we can pretty much count on. One is people want energy security. They want to be able to flip the switch and the lights are going to come on, or they want to be able to turn the key and the car is going to start up and they're going to put it in drive and it's going to move forward. But the other thing that happens is that people, especially in emerging markets, as they begin to have more disposable income, they improve their diets. And specifically, they consume more protein. And it takes more and more grain to produce more meat. So those are two very powerful long-run macro trends that should support demand for food and grain. And on the other side of the coin, at the same time, while we have demand for food and grains increasing, we're losing farmland at a pretty alarming rate. And the reason for this is that if you look at all these studies and white papers and so forth that come out of academia, you'll see that that study demographic trends and so forth. You'll see that the world's urban centers are not becoming denser; they're actually becoming more expansive. And as they radiate outwards, they start to encroach on agricultural land. And that's happening even here in the US. So I'm gonna share a statistic with you that's really hard to get your head wrapped around, I think. And that is that in the US, between 1997 and 2022, so a 25-year period, we lost over 74 million acres of agricultural land. And if you do the math on that, here's where it gets really mind-bending. That's 8,000 acres a day, okay? Which is crazy. That's 5 acres every minute of every day for 25 years. It's incredible. And, we believe that as these trends continue, every remaining acre of farmland is going to have to become more productive, and it seems likely that it's going to become more valuable. So when you kind of sum it all up, you have this real asset, farmland, that produces an essential good, and it's in declining supply. And that is a pretty good setup, we think, for a long-run investment opportunity.
No doubt.
Absolutely.
So let's keep moving. We've talked about what makes farmland such an intriguing asset class. Attractive risk-adjusted returns, the diversification qualities, proven effectiveness as an inflation hedge, and these macro tailwinds. So the next obvious question, I think, is, well, how do I participate as an investor? Well, you certainly could go out and you could purchase a farm directly, but this is going to require a pretty substantial capital outlay. At today's prices, central Illinois, central Iowa, for an 80-acre quality parcel, you're looking at easily $1 million and up. So obviously there are a number of reasons why this wouldn't work for many investors. Either, you don't have the financial wherewithal to plunk down that kind of money, or you just don't want to commit that amount of money to this particular asset class. You're worried about how you're going to manage that farm after you've bought it and so forth. And so this is where the Grainfield funds come in. They're designed to give investors a convenient way to access the market at a reasonable investment minimum. And of course, it's a professionally managed, diversified fund.
That was, I don't know if this is the time you want to talk about that or not, Dan, but I've found the minimums here to be very attractive when you're talking about these type of, private investments, non-traded investments. Oftentimes, even in cases, even in modern times when those minimums have come down, they still can be quite high. And Grainfields is very attractive compared to the rest of the market.
Well, that is, I'm glad to hear that, Ethan. And, that's by design. Hopefully my enthusiasm for this asset class is coming through. And, it's been a great investment for my family over time. I think it could be a great investment for a lot of other individual investors and families. And so we're trying to make it accessible. And one of the ways that you do that is, you set your investment minimum at an attainable level. And so we've tried to do that with this Grainfield fund too. Well, I should probably introduce some of my partners here at Grainfield Capital Management. They are Randy and Chad Hertz. And Randy and Chad own and operate a company over in central Iowa called Hertz Farm Management. It's based just outside Ames, Iowa, home of Iowa State University. I know they're pretty excited about the basketball situation right now over there. And Hertz's business is managing farmland on behalf of absentee landowners, individuals, families, institutions like hospitals and colleges that have been bequeathed farmland. And they can provide as much or as little management as the landowner would like. Some landowners want to play a part in the management of their farm, and that's great. Other landowners want to be totally hands-off, and in that case, Hertz can manage every aspect of the farm on behalf of the owner. A little bit more about Hertz. It's a family-owned business. It's been around for 80 years. Has developed quite a reputation for honesty, integrity, professionalism, fair dealing. You've got to be that way to have gotten to Hertz's size. They manage about 3,000 farms today, comprising about 700,000 acres with a current estimated market value of over $7 billion. So pretty good size operation, 14 offices across the Corn Belt, and more than 100 employees, accredited farm managers, licensed land brokers, accredited appraisers, and so forth. So there's just this kind of enormous pool of knowledge and talent and experience within the Hertz organization. And because the Grainfield funds have an exclusive and proprietary partnership with Hertz, we're able to leverage all of it for the benefit of our investors, which is a pretty cool thing. So how exactly, when I say we're able to leverage the Hertz resources, how do we do that? Well, as you can imagine, Hertz has built quite a network over all these years, really, really deep localized knowledge and relationships. we're showing a few on this slide, but we're not showing, lawyers, accountants, bankers, ag-related businesses like implement dealers, seed companies, and so forth. Hertz knows everybody out there in the countryside, very, very plugged in. They've developed the kind of network that you just couldn't replicate. And this network creates some pretty powerful advantages. For starters, most importantly, a really unmatched land sourcing pipeline. So we hear about farmland that's coming to market before it's even come to market. Access to top producers, obviously tremendous farm management expertise, and so forth. And so the Grainfield funds, by virtue again of the fact that we're the exclusive partner to Hertz, and Randy and Chad Hertz are Grainfield partners, we're able to leverage all these Hertz advantages to produce the best possible outcome for our investors.
Pretty awesome stuff.
It is good stuff. I should probably dive a little bit more deeply into our strategy, but we can probably kind of breeze right through this slide. I just wanted to mention again here that, our focus is on quality, productive corn and soybean row crop land in the heart of the Corn Belt. And I just wanted to point out how those 14 Hertz offices that you saw a couple of slides back match up pretty nicely with this map of the top producing counties in the U.S. And that's obviously not by accident. Hertz and Grainfield have a really strong presence exactly where the best, most desirable farmland is located. And so I guess you could say we have boots on the ground exactly where they're needed. We're very, very well positioned and plugged in.
Yeah, that's a big advantage.
It really is hard to overstate that advantage. Those relationships, that network, just kind of being tied in. So we're very, very selective with respect to the farms that we pursue for the portfolios. We look at any potential farm from just about every possible angle, and it has to meet our criteria. And you can see some of those criteria laid out here. If a target farm does meet our criteria, then we set out to value it. And we're really, really disciplined about not exceeding a price that we believe is reasonable, because it's true with farmland, just as it's true, I think, with just about any type of real estate, that how well you're able to buy a property in the first place can have a really big impact on your eventual returns. So we're really, really disciplined in that regard. So assessing a farm, valuing it, and then being really disciplined about the acquisition process are keys to our strategy. And then, and then as I said earlier, again, value add strategy. We're looking for farms that offer us some type of value add feature or opportunity that we can capitalize on to improve the farm's sustainability, productivity, and efficiency. In other words, we want to buy really good farms and we want to make them great. And that is how you create value and generate, we think, market-beating returns.
Absolutely.
I thought I would include this slide and just touch briefly on the topics of stewardship and sustainability, just because there's so much focus on these things in the investment world today. And here's kind of my message in a nutshell. Hertz and Grainfield together have been engaged in sustainable regenerative farming practices since long before these terms really became fashionable. And there are a couple reasons for this. First, our families consume the food we produce too, same as yours. So we want it to be, as healthy and nutritious as possible. But second, and this kind of throws people for a loop sometimes, sustainability and profitability actually go hand in hand. And I know there are some voices out there that, sort of imply that, farmers and landowners don't really want to engage in sustainable practices because it costs us money. Well, this couldn't be further from the truth. In reality, we don't want to make more passes across the land than we need to. We don't want to burn more diesel fuel than is necessary. It's really expensive right now. We don't want to pay for and apply, excuse me, more fertilizer or chemicals than we have to. So, we operate in a sustainable manner, and we do it not only because it's the right thing to do, but because it's actually to our economic benefit to do so. So we're aligned.
That's very interesting. I feel like in most cases, that's not the case. They conflict with each other. Profitability conflicts with the sometimes the sustainability of what you're doing. So that's an interesting. I never thought of that before. I don't think you've mentioned that to me before. That's an interesting case there.
Yeah, and I think your point, Ethan, is a good one. Sometimes they are in conflict or misaligned, but in this particular case, they're really not. We're trying to be good stewards of our land. It's obviously our most important asset, so we want to take great care of it. We want to enhance it, make it better. But it's also to our economic benefit to not apply more chemicals than we have to, not burn more diesel, not churn up the land and pass the equipment and create equipment wear and tear any more than we have to. So, so we're totally aligned with sustainability and regenerative practices. We've been doing it for a long, long time, and we look forward as technology evolves to becoming even more sustainable.
Love it, man.
Okay, so I wanted to include this slide. When you put it all together, you wind up with something that looks like this McLean County, Illinois farm, which is one of the properties in our first Grainfield fund. And it's a great example, I think, of the type of farm that we'll be looking for in this next fund. And it really highlights how we look for farms with a value add feature or an opportunity. So this is a great farm in central Illinois. Obviously, some of the most fertile, most productive soils anywhere in the world. It's an A location, very well situated. By virtue of our relationship with Hertz, we were able to enter into a relationship with a top-notch operator, a very large-scale farmer, very efficient, technologically advanced, great steward of the land. This farm has a relatively new high-efficiency wind turbine on the property, which we like. Produces a stream of income that's totally independent of our farming operations. And we installed drainage tiling on this farm. And we were able to do that with no cash outlay on our own part. The operator who rents this farm from us did it at his expense in return for a multi-year lease, which we're happy to do because, again, he's an excellent operator. And drainage tiling is one of those little tricks that we really like that improves the value of a farm because it boosts productivity, it boosts the cash rent potential of the land, and it helps to boost the asset value over time. And lastly, because we've got all these improvements going on and the drainage tiling, top-notch operator, we're very, very optimistic that we're going to be able to get this farm enrolled in a seed corn contract, perhaps with Bayer, maybe Syngenta, a company like that, which provides to us certain cost savings as well as pays us premium prices for the grain that we produce on the farm. So this is a great example of the type of farm that we prefer and the value add vision that we have for every farm in the portfolio and how we go about executing that vision. Pretty representative of the types of farms that you can expect that will hold in the Grainfield 2 fund that we're now raising.
Did you, in most cases, you're looking for operators, right? You have operators on the farms. You're the investors, and then you have really high quality operators that are essentially renting the land from you. Is that correct?
Well, we can operate the farms a couple different ways, Ethan. So Hertz, again, because it's so plugged in, it knows all the best operators in any neighborhood. So, who are the guys who use technology, who are efficient, who are good stewards, who are fair dealers? It also knows the guys to avoid, by the way, which is maybe equally as important. So sometimes we lease our farms, which is interesting to us because when we lease a farm to an operator, we don't have any weather risk. We don't have any production risk. We don't have any commodity price risk. So that's one way of doing it, and we do that. At the other end of the spectrum, though, is if we think that, after analyzing a farm, if we think it makes more sense to engage in full-scale farming, we will contract with an area operator and pay him to carry out all of the farming functions for us. So we'll pay him to plant in the spring, we'll pay him to apply fertilizer, we'll pay him to harvest in the fall, and so forth. Sometimes that's the best way to operate a farm. But whether we're cash renting a farm or operating a farm, every one of our farms has a Hertz accredited farm manager assigned to it, overseeing everything. So, and then of course the principles of Grainfield Capital Management are sitting over the top of that. So we've got multiple layers of supervision, and whether we're cash renting a farm or operating it, we always have an excellent top-notch operator.
Definitely.
Landon, does that look like the kind of field that you were running around in as a kid?
It does. And as soon as you said McLean County, I grew up south of McLean County, but have been in that general area. Yeah, that looks exactly like my home base, brother.
Looks familiar, huh?
Yes, it does.
Excellent. Okay, well, we're getting toward the end, guys. Thanks for sticking with me. But just a quick summary here of Grainfield 2, our new offering. It is structured like a lot of private investment funds in that it's a 10-year life of fund. The minimum investment, as you know, we mentioned earlier, is $100,000. But this is really important. You're not expected to write a check for the full amount up front. Rather, we will call the capital in installments when and as needed. So you hold on to your money until we're able to put it to good use. Wanted to point out here too, we try very hard to be investor friendly and fee light. The annual management fee on this fund is just 1%. And really have to underscore this. This includes Hertz Farm Management Services. So there's no double dipping here. That comes out of the 1% annual asset management fee. There is a 20% incentive fee, but that only comes into play after investors receive back their investments, plus a 6% per year average annual total return. That's the hurdle that has to be cleared before the incentive fee even becomes a factor. And lastly, I should point out it's important that the fund is designed for accredited investors. So you do have to meet the SEC's accredited investor requirements, which I'm sure are familiar to everyone on the webinar.
Yes, indeed.
Ethan, Nick, any questions about this slide?
Yeah, I wanted to highlight one thing. We were on a call with an advisor earlier this year, and she brought up a great question about leverage utilization capacity. And I thought your answer was really interesting and really compelling as well. And just was hoping you could talk to that a little bit.
Sure. Yeah, leverage. Great question, Nick. So we are authorized in the offering documents to use up to, I believe, 20% leverage. Yep, 20% leverage. You might be surprised to hear this, but in Fund 1, 0 leverage. We didn't use any leverage. And my expectation, just given where rates are today, is we're probably not looking to use leverage in Fund 2. So whenever you see us, publishing these returns and targeted returns and so forth, those are all unlevered returns. And really two reasons, Nick, for that. First is just kind of an economic reason is that, farmland, if you're good at what you do, farmland produces, let's say, around a 3% average annual total cash return. And that's stretching it. You got to be good. You got to have something going on like we do, where you've got a seed corn contract or you've got a wind turbine or something like that. But the point is 3% per year doesn't really pencil out with land loan rates right now today. It just doesn't make economic sense. So that's one reason why we don't really like to use leverage. The other reason, though, is more philosophical. We just think the world has enough really complex, opaque, highly leveraged financial deals out there. And farmland is not supposed to be that. Farmland is supposed to be, an honest, relatively easy to understand investment, low leverage, if any at all. And so we're just trying to be true to what we think the spirit of the investment is. So I hope that makes sense.
Absolutely. No doubt about it. There's no scarcity of products with high leverage and complicated terms.
Yeah, for sure.
You mentioned,
Well,
Dan, the distribution yield of about 3% is average. Has Grainfield in your first fund, and do you plan on making distributions? How has that worked historically throughout the lockup period? Have you returned cash to investors?
Yeah, great question, Ethan. Thank you. So Fund One's investment period, the formal investment period, just ended this past December 31st. But we were able to make our first annual cash distribution to investors even last March, even before the end of the investment period. And we're actually, it's funny you should ask that, because we're scheduled tomorrow, Thursday, to make our second annual distribution for 2026. And so we're excited about that. So we're tracking according to plan in terms of making distributions. One other point, just while we're on the topic of distributions, we've been really, really pleased with the tax efficiency of our first fund. And the reason for that is, because we're making these value-added enhancements like installing drainage tiling. We have a farm in Nebraska where we actually, you might be interested to hear this story. When we bought the farm, Hertz, because it's so plugged in, had pretty good reason to believe that a company called Tallgrass Energy was going to be wanting to put a CO2 transmission pipeline somewhere through the area where this farm lies. So we evaluated the farm. We liked it for a lot of reasons. We bought it. We kind of had in the back of our minds that, yeah, wouldn't it be great if this CO2 transmission pipeline goes through here? Well, sure enough, Tallgrass Energy approaches us. They want to run the line right across the east edge of our property. So we sell them an easement. We take the proceeds from that easement sale and we invest in a brand new, fully modernized irrigation system that covers the entire 160-acre farm out there in Nebraska. And so that allowed us to get it enrolled in a seed corn contract, the whole thing. It was a great example of how one value add improvement leads to another. Well, the reason I bring this up is that investment in that irrigation system, the investment in drainage tiling in the Illinois farm that I showed you, McLean County farm, those are depreciable assets. And with today's opportunities for bonus depreciation and so forth, a lot of those can be sort of front loaded in the early years of the life of the fund. And so these cash distributions and earnings that the fund has have been largely, well, actually, they've been totally to date tax advantage, shielded by these depreciation charges. So, and we expect that that's going to continue for the next year or two. Eventually, those depreciation charges will be fully used up. But we think at least for the first 4 or 5 years of the life of the fund, the earnings will be pretty well, if not entirely, shielded by depreciation. So long-winded answer there, but that's the story on distributions and depreciation.
I don't know who lobbied for that depreciation rule to be a thing, but they're a genius. And I always argue that if the population understood how that worked for the wealthy, they'd be in the streets rioting, but nobody actually understands it really well. And especially when you still get a stepped up cost basis even if the asset's been depreciated down to zero. full stepped up cost basis upon assuming that the ownership structure and all those things. But it's a it's a magical tax play, brother. It's beautiful.
It is. And here's something that will blow your mind a little bit, Landon. We can even depreciate excess fertility in the soil. So one of the things that we do when we buy a farm is we go out there and we do grid sampling, and we determine, what are the fertility levels on this piece of ground compared with what are the, say University of Illinois or Iowa State recommended levels. And we're able to take a depreciation charge against earnings for the value of the fertility in excess of the recommended university levels. That's a little bit of a simplification, but that's something that a lot of people hear and they're like, wow, I had no idea you could do that.
Absolutely. Awesome stuff, man. I love it.
Well, this is my final slide, guys. I thought this would be a good place to wrap up. I think it captures really nicely why we're excited about the timing for this next fund. And you can see that going back as far as the mid 1980s, farmland values have generally been on an upward trajectory. And even periods of modest softening in land values, even really periods of just sideways consolidation, have turned out to have been really good entry points. And you can't really see it on this chart, but over the past year, we've been in one of these pretty flat farmland markets. And, the farmland market really has just kind of been consolidating and moving sideways, over the last year, sort of digesting everything going on in the world, just steady, stable, resilient, but really moving sideways. And so, we think this could really very well be one of these attractive times to put capital to work in the farmland market. So feeling really, really upbeat and positive about the timing for this new fund.
I love it. I think we're going to have some advisors that feel your excitement, that are going to be looking to get that non-correlated return structure, the zigging, the zagging. That's what everybody's looking for, especially right now with all the uncertainty and everything else. So, yeah, man, we're excited, and I think the feedback from our advisors is going to be very similar.
Well, that is great to hear, Landon. And with that, guys, we've reached the end of the presentation. It's been a real pleasure to have joined you today. Thank you very much to everyone watching. It's been a pleasure speaking with you guys about farmland as an investment, and really appreciate the chance to tell you about our Grainfield funds.
Yeah, we appreciate you, Dan. It was awesome.
Yep.
Thank
Well,
you,
if you have
Dan.
any questions or you'd like to learn more, feel free to reach out. Always happy to have conversations with investors, and glad to send any of the materials that you've seen here today.
Awesome. Thank you so much again.
All right. Thank you, guys. Have a great day. Thanks for having
Bye.
me. Bye-bye.
Thank you, everyone.